Hey, what's up, my friend? So welcome to the Ultimate Chart Patterns trading course, right? So who is this course for? This course is for you if you're a beginner trader or an advanced trader, right? Here's how it works, right? This course is built in a step-by-step manner, right? So even if you're a new trader, you can follow along this course, right? Every step of the way. And towards the end, right, we'll build up on what you've learned and share with you advanced strategies and techniques, right? And this will be, useful stuff, especially for those of you who have already some trading experience. Now, it doesn't matter whether you're a stock trader, a forex trader, or a crypto trader, because this course, right, it can be applied to these markets because the strategies, the techniques, the concepts can be applied across these different markets. Now, I've packed a lot in this course, right? So I'll put a timestamp somewhere on the screen so you can refer to it if you need to. And you might think, oh, Rayner, I already know some of these chart patterns. Well, guess what, right? I still recommend you watch it from start to finish because the way I interpret some of these patterns, the way I trade it is actually quite different from what the textbooks, what the other courses teach you. So I recommend you go through them with me so you kind of like know Rayner's version, yeah? So the goal for you from this course is very simple, right? I only have 3 goals. Number 1, to teach you how to use chart patterns to better time your entries and exits. Number 2, how to use chart patterns to predict market turning points so you don't get caught on the wrong side of the move. And finally, number 3, to equip you with chart pattern strategy so you can profit in bull and bear market. Sounds good? Then let's get started. Now, the first chart pattern that I want to share with you is called the double top pattern. So this is, in essence, right, a bearish reversal chart pattern. So how does this work? Let me explain. So when you spot a double top, right, you will see that the market at first is in an uptrend. Then it makes a pullback. Then it retests the highs once again and then makes another pullback. So at this point in time, right, the market is actually still bullish. There's nothing bearish about this chart at this point in time. But where things starts to get kind of suspicious is when you have this neckline over here. Okay, and if the price breaks below this neckline, we would say that let's say imagine it breaks below the neckline, we would say that the double top is sort of confirmed and the market is likely to head down lower from here. So let me give you an example of how this looks like on the chart. So you can see over here, this is the double top pattern. It tested once, got rejected down lower, tested twice, got rejected down lower, and at this point is where it broke below this neckline, otherwise also known as an area of support. So how can you trade the double top pattern? So there are many ways to do it, but one simple method is this, right? So at first, let's talk about how not to trade it. So a mistake that many traders make is that when they see a breakdown of this neckline, they go short on this market. What's the problem with this? Is that if you have been trading long enough, you know that the market could come down lower and then quickly reverse back up higher, otherwise known as a false breakout. So if you short just because the market broke below the neckline, you're going to be, pretty disappointed quite often. Okay, so what else can you do? Well, a better approach, right, is you can actually wait for the break and retest. So you know that this is an area of support. You can let the price break down lower first and then retest this area of support. So this could be, a retest and giving you an entry trigger like the shooting star pattern like this. Okay. And this, right, tells you that, hey, sellers are stepping in, right? And this over here could be previous support, which could turn into resistance. Then you can look to enter on the next candle open, stops a distance above the highs, possible target just before this recent swing low. I don't want to go into the trading strategy yet because we'll cover that later on, but this is just an idea to how we can possibly trade the double top chart pattern. And by the way, if you want to learn how you can actually enter a double top pattern, right, before the price breaks below the neckline, right? Then, stay with me towards the end of this training because towards the trading strategy section, I'll share with you how you can actually enter your trade before the price breaks the neckline. And when that happens, this means that when the price reaches this neckline, you're already in profit. So I'll cover all that and more in later part of this video. But for now, let's move on and talk about the double bottom pattern. So this is the inverse is actually a bullish reversal chart pattern. It looks something like this. Market is in a downtrend. Then it hits this low over here and makes a pullback up higher. Okay, then it retests back the low and bounces up higher. So at this price point, at this point in time, this market is still in a downtrend. There's nothing bearish about it because if you look at it, the lower high, the lower high, the lower high, it's still intact. And at this point, this is where you can actually also draw your neckline over here, otherwise known as an area of resistance. And when the price, if it does break above this neckline, this is where we say the double bottom pattern is confirmed, right? You can see the double bottom tested once, tested twice, and then this break above this neckline is where we say the double bottom pattern is confirmed and the market could head up higher. So visually, it looks something like this. Okay, so you can see over here, market is in a downtrend, tested once, bounce up higher, making a pullback, tested twice, okay, bounce up higher. At this point, this is where we say the double bottom pattern is confirmed because the price has broke out of the neckline. But as you have known by now, right, you shouldn't trust this breakout just because the price closed above it, because what could also happen is the market could just as easily reverse down lower, forming a false breakout closing back below resistance. So how do you trade the double bottom pattern? So one way to go about it again is to actually wait for the break and retest. Let the market break out and retest this previous resistance, which could become support. Let it retest it. Right? So once it retests, you can then look for a bullish entry trigger like a hammer or something like this, okay? Right? And to tell you that, hey, buyers are stepping in and about to push the price higher, because that's the meaning behind a hammer, right? Where the price, at one point in time, this is the opening price. It traded down towards this low, only to have the buyers stepped in to push the price up higher, closing, right, at this price point, okay? So this is a sign of strength, and this is where buyers could possibly come in. So you can look for a bullish entry trigger to go long, stops a distance below this lows, possible target could be just before this recent highs, okay? So again, we will talk about the trading strategy, entries and techniques later on, but that's one way you can go about trading the double bottom chart pattern. Next, you have the head, shoulders, knees and toes, knees and toes. Head, shoulders, knees and toes, knees and toes. That's what happens when you have 3 kids and they play nursery rhymes every single day in your house, right? So anyway, the head and shoulders chart pattern, right, is pretty much a bearish reversal chart pattern. So let me explain how this works. So this one over here, again, market is at first in an uptrend. Then it makes a pullback and fire off higher. Then it comes back down lower, retesting these lows over here. So at this point, again, market is still bullish. Market is forming a series of higher highs, higher highs, higher highs, higher highs, higher highs, and higher lows, higher lows. So where things starts to take a turn, right, is where you notice the right shoulder being formed. Price heads up higher, and then starts to come down lower again. So at this point, right, this is significant because it tells you, right, the buyers, they have difficulty retesting these highs over here. They have difficulty pushing the price up higher. They have difficulty breaking out higher. So this is a sign of weakness, but it doesn't mean that the market is going to collapse. No. So at this point, this is where you can actually identify the neckline. Okay, some people call it support, some call it the neckline, whichever. And the head and shoulders pattern is only confirmed, right, when the price breaks and close below this neckline over here. Okay, so when that happens, right, we will say that the head and shoulders pattern is completed and the market could possibly head down lower. So visually, it looks something like this. Okay, so let me show you. So this head and shoulders pattern is a little bit different, not as symmetrical as what you've seen earlier. This is the left shoulder. This is the head, the one that is sticking out, and this is the right shoulder. And what you'll notice is that the left shoulder is the duration is a lot longer compared to this right shoulder, and it's still a valid head and shoulders pattern. The reason why I share this with you is because in trading, sometimes the pattern are not as symmetrical, it's not as textbooky as what it might seem. So sometimes the core principles is still there. There's still a left shoulder, which is this one over here. There's still a head, and there's still a right shoulder, but it's not quite as symmetrical or textbooky, right, as what you might expect. Again, just want to kind of prepare you for the real world of trading when you spot such chart patterns. So now, how can you trade the head and shoulders pattern? So one way that I don't recommend doing it, right, is that, if you see the price breaks below the neckline over here, you go short. The problem is where you're going to set your stop loss. Okay, so some traders might set it, let's say above this head over here, right? Because if the price goes all the way back up and hits this level, breaking out the head of your head and shoulders pattern, then of course this pattern is invalidated. Problem with this is that your stop loss is pretty darn wide. It's like huge, right? So to even achieve a 1-to-1 risk-reward ratio, it's going to take a while, right? So a better approach, or another approach that you can consider, is, again, we talk about the break and retest method that I shared with you earlier. Alternatively, I'm going to share with you a new one over here, is what I call the first pullback. So why do I call this the first pullback? Because at this price point, notice how the price breaks below support. Okay, so if it makes a pullback now, this is what I call the first pullback, because this is the first time the market has made a pullback after this breakdown over here. So let's say it makes a pullback, forming kind of like this bearish flag pattern. Again, this is a chart pattern that I'll share with you later on. And if the price does head down lower and break below this low, this is where you can go short, right? Go short at this price point. Now, what's the difference between shorting at this price point and shorting earlier? Well, the main difference is that now you can actually reference these highs to set your stop loss. Your stop loss is going to be more tighter right now. So when you have a tighter stop loss, you get a more favorable risk to reward. So let's say you short at this price point, your stop loss now is somewhere over here. Can you see how much tighter your stop loss is, right? And that's one way you can go about trading the head and shoulders pattern. Okie dokie. And by the way, if you're enjoying this trading so far, smash the thumbs up button. If not, hit subscribe. So the inverse head and shoulders pattern. This is just the inverse, or rather the opposite of what I shared with you earlier. So it's a bullish reversal chart pattern. So it looks something like this. Okay, so this is usually when the market is in a downtrend like this. Okay, then it makes a pullback up higher. Then it takes another step down lower. Then it makes a pullback up higher. Okay, so at this point again, market is still bearish. There's nothing bullish about this because you can still see a series of lower lows, lower lows, and lower lows. So where things start to take for a turn is pay attention to this price action over here. Market heads down lower. Okay, and this time around, it wants to again continue this downtrend. And to continue this downtrend, it has to break below this low. But guess what? It couldn't break below the low because buyers are coming in to push the price higher. Buyers are stepping in. And this is where you notice the price action takes a turn and starts to go up higher. So at this point, this is where you have your left shoulder, this is your head, and this is your right shoulder. Again, nothing is confirmed now. Nothing is going to say that, hey, this is the reversal until the price breaks above this neckline. Okay, so until the price can break above this neckline, this is where we say the head and shoulders pattern is completed and the market could possibly head up higher. And a tip to share with you is that for classical technicians, right, they will use something called the price projection to kind of determine where the head and shoulders, where the inverse head and shoulders price could terminate at. So let me give you a quick example. So let's say the low of the head over here. Okay, let's say I'll just use this point. Let's say the low of this head over here. Okay, the price is trading at $50. Okay, and let's say the highs of this neckline over here. Let's say the highs of this neckline, the price is trading at $100. So from $50 to $100 is a difference of $50, right? So in other words, the entire distance of the head and shoulders pattern from the head to the neckline is $50. So when we try to determine where the market could potentially terminate at, we just simply take that distance and kind of like project it up higher. So in other words, right, $100 you plus $50 because that's the distance of the head and shoulders pattern. You can actually kind of say that, hey, no, at $150 price point, let's say somewhere about here, this is where $150, this is where the head and shoulders pattern could be completed at, and that's where you could actually face selling pressure where the market could reverse from there. So this is how a classical technician chartist, right, they use price projections to determine where the chart pattern could, move till. Okay, so an example of how the inverse head and shoulders pattern looks like, something like this. Again, the left shoulder, this is the head, and this is the right shoulder. And what is this? This is what we call the neckline, otherwise also can be called a resistance. So at this point, you can see over here, this market has actually broke out of this neckline over here. And actually, right, in this particular instance, one way you can trade this is actually to trade the breakout. Why is that? Because if you think about this, when this market breaks out over here, why is this a tradable breakout? Because you can actually have, or rather, two things. Number one, you can actually reference this low, this swing low, to set your stop loss. You have still a pretty tight stop loss. So from here to here, right? Let's say you set your stop loss a distance below this low, so somewhere here. Your stop loss here, this is still pretty tight. Okay, so that's one thing in your favor. Number two, notice how this market, right, is actually consolidating just before this area of resistance. This consolidation, otherwise what I call as a build-up, is a sign of strength. It's telling you that, hey, the market, it has difficulty heading down lower. Because imagine if the market is in a downtrend, then by right, it shouldn't be consolidating here so long. By right, it should actually just pretty much continue down lower, break down below this low, continue its lower lows and lower highs. But the fact that it's actually hovering at resistance, the fact that it's still consolidating over here tells you one thing: buyers are stepping in and could possibly push the price higher. So that is, again, is a bullish, I would say, price action signal that will warrant you, right, to actually trade the breakout out of this head and shoulders pattern. And again, why it's a tradable breakout, unlike the earlier examples. Let me share with you the earlier examples if you haven't recall. If you look at this one over here, if you trade this breakout over here, let's say you refer to the nearest swing high is actually this one over here, and your stop loss is going to be over here. Pretty darn wide. Yeah? Okay? Now, if you compare this to the stop loss that you have on this one over here, can you see the difference in tightness of the pattern? And as you know, right, the tighter the pattern is, the longer the market is kind of like in a squeeze, probably it will lead to a stronger breakout. So in this instance, right, this is one way you can go about trading the inverse head and shoulders pattern, only if, right, you have this consolidation, you have this build-up form, right, at the neckline. Only if you have that. If not, you can go about trading the first pullback or the break and retest strategy, which I've just shared with you earlier. And don't worry too much about the strategy part, because later on I'll dive deeper with you on how you can actually use chart patterns, right, and develop your own trading strategies. I'll walk you through trading strategies that I use myself to trade the markets, and more on that later. Next, we have the triple top chart pattern, right? So this is actually a reversal chart pattern, a bearish reversal pattern, and it's actually a variation of the head and shoulders pattern that you have seen earlier. And in fact, it can also be a variation of the double top pattern. So let me explain how this works. So again, market is in an uptrend, okay? Then you retest the highs, you test the highs, makes a pullback, then retest the highs once again, then makes a pullback. So at this point, right, if the market breaks below this neckline, we will say that there's a double top pattern, and it's confirmed if the price breaks below the neckline. But what if the market retest the highs once again? So you can see it retested once, twice, and over here it comes down lower. It retested thrice, sorry. And then this is the neckline you have. Okay, so again, if the price comes down lower and breaks and close below the neckline, we will say that the triple top chart pattern is completed and the market could possibly head down lower. And the price projection principle that I shared with you just a few moments ago, it can be applied to the double top, the triple top chart pattern as well. So let's say, for example, this one, the highs over here, let's say it's $200. Okay, and let's say this neckline, the low of the neckline is, for example, $150. Now, quiz time. If the market breaks below this neckline, where could you project this pattern to terminate at, to kind of like, officially terminate at? I wouldn't say officially, but where the technicians, right, will say that this price projection could complete at. It could complete, basically you take the distance from this highs to this lows, it's $50, and you just take 150 minus $50 and it's about $100. Okay, so you can say that this pattern, right, could be complete, right, at this $100 price point. So at $100 is where you could say that, hey, buying pressure could come in, right, to push the price up higher. So that's what the technician, the chart pattern technical analyst use this price projection method to kind of like give them a target price. Yeah, okay, so this is the bearish reversal chart pattern, and visually it looks something like this. So you see here, market head up higher, tested once, make a pullback. Heads up higher, tested twice, makes a pullback. So again, at this point, nothing bearish on this chart because the market has just still formed a series of higher lows. You can see higher low, and here close to the previous low. So again, nothing bearish about this. Then the market heads up higher once again and come down lower. So at this point, again, you have the market looking something like in a range in an uptrend. So at this price point, again, I won't say the market is bearish because it's kind of like contained within a range. And if you look at the previous existing trend, the overall market previously is in an uptrend. Okay, so at this price point, right, I will actually lean more towards looking for buying opportunities. But the game changer happens, right, when the price breaks and closes below this neckline. On this candle, it breaks and closes below the neckline. This is where, again, things have changed and I'll shift my bias from bullish now to bearish. So how can I trade the triple top chart pattern? Again, what I don't usually like to do is that I don't like to short over here and then have my stop loss, let's say, for example, above this highs. Because again, the distance of your stop loss is too pretty darn wide. So all the techniques I shared with you earlier, the first pullback, the break and retest, yeah, those are techniques that you can use to trade the triple top chart pattern. So for example, we can go with, again, for example, let's say go with a break and retest, market hits down lower, then it comes back up and retest this previous support, which could become resistance. You can look for something like, again, a shooting star pattern like this. Okay, this telling you that, hey, selling pressure is coming in and the market could possibly reverse down lower from here. So this is one setup, right, that you can look for to trade the triple top chart pattern. Okay, next one on the list, the triple bottom chart pattern. I'll go slightly faster now since I think you should probably know what to expect. So this is a bullish reversal chart pattern. So this is where the market at first is in a downtrend, then it makes a low, bounce up higher, comes back down lower, retest these lows, bounce up higher, retest the lows once again. They thought they could break the price down lower. The sellers, they thought, man, this is our time, it's victory, whoa! But guess what? Market bounce up higher and then they fail to take the price down lower. So at this point, you have what we call the neckline over here. And if the price breaks above this neckline, this is where we say the triple bottom pattern is confirmed and the market could possibly head up higher. Okay, so visually, it looks like this. So notice how cute this is. Bounces one, toing, goes up, comes back down, bounce here, toing, goes up, comes back down third time, toing, 3 times. So 3 bounces, 1, 2, and 3. So 3 times, 3 attempts to drive the price down lower, but the market just can't go down lower. What is that telling you? That's telling you that if it can't go down lower, then it probably should go up higher. Duh, right? So this is where, again, the market, once it breaks above this neckline, it could possibly head up higher. And one thing about trading is that, yes, a lot of traders, technicians, they like to use the word confirm, right? The candlestick pattern is confirmed, the reversal is confirmed. But when it comes to trading, nothing is confirmed. All the stars can align. It can look as confirmed on the chart. But guess what? Things can still go in the opposite intended direction. So for example, over here, the market, for all you know, it could just break out and next candle, bam, right? You have this bearish reversal candlestick pattern, right? Signaling that, hey, this is a false breakout and the market breaks down lower. That could happen as well, but they like to use the word confirm. So I'm using the word confirm here with a quotation, this finger ding 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 to signal to you that, don't take it as a 100% guarantee, but take it with a kind of like a probabilistic mindset. Yeah. So this is the the triple bottom chart pattern. So how can you trade this? So again, numerous ways. You can use the break and retest, the first pullback, something like this, goes up, then maybe it makes a pullback like this. Okay, some tight consolidation. Then you can kind of like identify this flag pattern, right? We'll talk about that later. And if the price breaks above this highs, you can look to go long over here. Okay. And where do you set your stop loss? Your stop loss can go a distance below this lows, somewhere about here. So from here to here would be the size of your stop loss. Okay, so you can see that this is a pretty nice tight stop loss. And if this is, let's say, really the bottom, right? And if the price does break out higher, you can see that you have a pretty favorable risk to reward on this trade as well. Yep, and that's pretty much it, right, for the reversal chart patterns. In the next section, we're going to talk about continuation chart patterns. Exciting stuff. So let's get to it. Okay, so next up we have the cup and handle pattern. This is our bullish trend continuation chart pattern. Okay, so this is the first one on the list, and how this pattern looks like is something like this. Market is in an uptrend, it goes up higher, makes a pullback, goes up higher, makes a pullback, goes up higher. And this time around, when you see a cup and handle pattern form, you'll notice that the pullback is much longer in terms of duration compared to the earlier pullback. This pullback, the duration is much longer. So it makes a pullback and then starts to, kind of like consolidate slightly over here. So at this point, right, there is nothing bearish on this chart. In fact, the market is still bullish because you notice a series of higher highs, higher highs, higher highs, and higher lows, higher lows, higher lows. And what you'll notice is that for the cup and handle pattern, the market will stage another rally to attempt to break out of these highs. And on this first attempt, it is where it has difficulty breaking out higher. So this is where you notice a small pullback over here where the sellers try to exert some selling pressure. But at this point again, sellers couldn't really push the price any lower. In fact, it has difficulty breaking below this swing low. So this tells you that overall the market is still bullish. And then at this point, you can actually draw this area of resistance / neckline. So when the market, if it does break above this area of resistance, we will say that the cup and handle pattern is formed and the market is likely to continue up higher. So an example is this over here. So notice how this market is in an uptrend, goes up, makes a pullback, goes up. This time around, notice the pullback, the duration is much longer compared to the earlier pullback. Then it tried to break out of these highs, but couldn't quite accomplish yet. So instead, what it does is that it makes a pullback from somewhat of a consolidation. And then when the price breaks above these highs, this is where we say the cup and handle pattern is complete and the market could possibly head higher. So now the question is, how do you trade the cup and handle pattern? So this one is, again, you can trade this, use trading the break and retest, the first pullback. But another way you can trade it is that notice how tight the consolidation is, right, for this cup and handle pattern. And by the way, in case you're wondering, hey Rayner, where is the cup? Where is the handle, man? So let me explain to you. So this is what we call the cup. Okay, when you hold your cup, right, the base of the cup, this is what we call the cup. And this over here is what we call the handle, where you kind of like hold the cup, the handle of the cup. So this is what we call a cup and handle pattern. So to trade this, right, what you can do is that when you notice the handle is very nice and tight, this is what we call a volatility contraction pattern. This is what we call a build-up, right? Nice tight consolidation where the buyers and sellers, they're kind of like in equilibrium, storing potential energy to kind of like, make the next move, right, shortly. So whether the next move is going to be up higher or lower is anyone's guess. But since you know that the direction of the trend is up, then you probably want to be trading right in the direction of the trend. So one way to go about trading it is that if the price can break above these highs, you can look to go long, right? And your stop loss can go a distance below this swing low somewhere about here. So your entry point somewhere here, stop loss is here. So let's call it entry E, stop loss here. So this one way you can go about trading the cup and handle pattern. And of course, the inverse is what we call the inverted cup and handle pattern. So this is a bearish trend continuation chart pattern. So to illustrate, it's something like this. Market is in a downtrend, hits lower, makes a pullback, hits lower, makes a pullback, hits lower. And this time around, the pullback is actually longer, right, than the preceding earlier pullback. So you can see that you can expect the pullback to be slightly longer, slightly deeper as well, okay? And then what happens, the market starts to head down lower, try to break out the lows, but not quite there yet. Instead, it makes another pullback, another rally up higher. But you can see that the rally is pretty weak, right? It's so weak that it couldn't even take out this previous swing high over here. And at this point, you have what we call a neckline or an area of support, if you want to call it. And if the market comes down lower and breaks below this lows of support, you can expect the price to head down lower. So this is what we call a inverted cup and handle pattern. So just to show you, over here, you can see the market makes a move down lower, a slight pullback, move down lower, a slight pullback, move down lower, slight pullback, a move down lower, and then you have a deeper pullback, and this time around the pullback is much longer in duration. And it starts to head down lower. It tries to take out the lows, but not quite there yet, and then it forms a consolidation, a build up over here. Okay, so at this point, this tells you, right, at this juncture, it tells you, the price action tells you that the buyers and sellers, right, they're kind of like fighting a war, right? The buyers are trying to push the price higher, but no, the selling pressure is stepping in, right? Holding the price down lower. And you can see that, to me, that's a losing battle, right, for the buyers, because they can't even push the price up higher to take out this previous swing high. So this, to me, is a sign of weakness. And since you know the overall trend is down, when the market breaks down lower, there's a good chance of this market continuing down lower. So this is what we call the inverted cup and handle pattern. And once again, to trade this, you can, trade what we call this build up over here. Notice this nice tight consolidation. This is significant because if the price breaks below this lows, you can look to go short. Your stop loss, again, because you have this tight consolidation, you have these highs over here, you can reference these highs to set your stop loss, possibly somewhere about here. Okay, imagine without this consolidation, right, the next logical place to set your stop loss is actually probably somewhere above this swing high, which is going to be pretty large. So that tight consolidation gives you a relevant place to set your stop loss, a tighter stop loss, which then offers you a more favorable risk to reward on the trade. Okay, the next one on the list is what I call the ascending triangle chart pattern. Well, I didn't call it the ascending triangle chart pattern. This is what people, traders, right, who came before me call it. And it's one of my favorite chart patterns to trade because it's a bullish trend continuation chart pattern. And I find that it's actually one of the most powerful ones to trade because the psychology, the price action, the meaning behind this pattern is just so significant. So let me explain how it works. So for the ascending triangle pattern, again, market is in an uptrend, goes up higher, makes a pullback, goes up higher, makes a pullback, goes up higher. It makes a pullback, then it starts to go up higher again, but fail to do so, then makes another pullback. But what's interesting is that this pullback now, okay, it did not take out these lows over here, right? In fact, it made a slight pullback, then it head up higher once again. And at this point, right, you have this, what we call a area of resistance. And sometimes we might have another smaller pullback before the price breaks out higher. So when it breaks out, this is what we call a ascending triangle chart pattern, because notice how the higher lows, one, higher low, higher low, higher low, you can actually connect the lows, right, and get what we call an ascending triangle chart pattern. So this, to me, is a sign of strength because it tells you that it's a story of the buyers, right, willing to fight tooth and nail for every inch, right, trying to push the market up higher. So you can see this buyers trying to push the price up higher, higher, higher. Even just in front of resistance, they're still willing to buy at this higher prices. So why would people want to buy in front of resistance? Why would they want to still be so how should I put it? Why are they still so strong, right? Even just in front of resistance? Well, probably because they expect higher prices to come. So that's why you're willing to buy in front of resistance, because you think that the market is likely to break out. So before it breaks out, you quickly get on board. So this is a sign of strength. Okay, so this is an ascending triangle chart pattern. So also notice, right, the story. Right? Imagine someone who is short this market. If you are, let's say, the market, someone look at this. Oh, price is at resistance, sell. Or price comes back into resistance, sell. The more time resistance is tested, the stronger it is. So let me short at resistance. So let's say you are short resistance. Now what happens when you're short resistance? Where will your stop loss be? Well, probably your stop loss is going to be above the highs of resistance, right? Well, that's what most textbook, what gurus will tell you, put your stop loss above resistance. So imagine, right, when the price breaks above resistance, it's going to hit this cluster of stop loss. And this cluster of stop loss are it's actually, buy stop orders. When you're short the market, your stop loss is in essence a buy order, right, to get you out of the trade. So when it hits that cluster of stop loss, that is strong buying pressure to push the price, right, further up higher. So this is why I love trading the ascending triangle chart pattern, because the psychological of the market participants getting trapped. The sign of strength from the buyers is just, it's what I just love to trade. And on top of it is usually what you get is a horizontal line over here, which is very easy to identify compared to slanted diagonal chart patterns, which can be a little bit more subjective when you draw those chart patterns. So here's an example of how it works, right? So you can see over here, market is in an uptrend, goes up higher, makes a pullback, goes up higher, it makes a pullback, goes up higher, couldn't quite break out yet, then makes a pullback, then over here it attempts to break out once again, and in this point it did manage to break out. So sometimes the ascending triangle could have just two higher low, right? Higher. This is one higher low, right? This is previous higher low. So there's two. Sometimes it could have three, sometimes even four. It really depends on how the price action of the market unfolds itself. But as a bare minimum, usually you want to look for at least two higher low to classify it as an ascending triangle chart pattern. But for me personally, I like to see at least, right, three higher lows. So it comes up once again, then makes another pullback, then over here. So I have 1, 2, and 3. So that is my preference to have at least three higher lows. So how can you trade the ascending triangle chart pattern? So numerous ways that you can trade it. So one example could be you can look to trade the retest, the break and retest. So market breaks out, comes back and retests this previous resistance that could become support. And you can look for something as simple as like a hammer candlestick pattern like this. Okay, so this is a hammer candlestick pattern telling you that the buyers are stepping in, right, and about to push the price up higher. So you can look to enter next candle open. Your stops can go a distance below the low. Possible target just before this recent swing high to capture that one upswing of this move, right? So that's one option that you can do. Another option is that you can look to trade the breakout, because notice that you have a series of higher lows coming into resistance, and this gives you logical place to set your stop loss. So let's say for example, market over here breaks out, right? You can actually reference this swing low to set your stop loss, possibly somewhere about here to set your stop loss. So of course, if you have more higher low, right, into resistance, you can actually visualize that your stop loss is going to be tighter. So just follow along with me for now. So let's say over here the price didn't break out, so there's nothing over here. Let's say it didn't break out, and if it came back down lower, then it goes back up higher, comes back down lower, and then over here, and finally it break out over here. Let's say it breaks out over here. So now at this point you can actually connect the upward trend line up slightly higher, and when you break out at this point, okay, notice that your stop loss now can be tighter. You can just reference this swing low and set your stop loss somewhere over here, right? So you have kind of like two obstacles, right, for the market to go through to reach your stops. Number one, it has to break below this swing low. That's obstacle number one. Number two, it has to break this upward trend line, right, to reach your stop loss. So you can see that your stop loss is at a very favorable location. It's pretty nice and tight, but at the same time, right, it's at a logical level. So this is now why I like to see multiple higher lows into resistance, right, when I trade the ascending triangle chart pattern. Usually I look for at least three. But yes, this chart example I provided only two. So deal with it. Alright, the next one on the list is the descending triangle chart pattern. Basically, it's a bearish trend continuation chart pattern. It's just the inverse of the earlier one. So market is in a downtrend, makes a pullback, continues down lower, makes a pullback, continues down lower, makes a pullback, tries to continue down lower but can't break below this low before the buyers step in and push the price up higher. Then he heads down lower again just couldn't break below the lows before the buyers step in and push the price up higher. And then this time around, it tries to break the lows once again. And what we have over here is what we call an area of support. Okay, so if the price can break below this area of support, this is where we say the ascending triangle pattern is complete, and the market could possibly head down lower. And if you look at the price action of this pattern, you know that it's a sign of just bearish. Look at the buyers, right? The buying pressure. You can see that it's getting weaker and weaker. First time, or rather over here, it pushed to this highs over here, right? Then subsequently it tried to push, but it couldn't even break above this highs before it continues down lower. And then this third attempt, it tried to push, again couldn't break above this highs before it continues down lower. So you can see that the selling pressure is getting stronger and stronger each time the buyers try to take control, but they just get squashed by the sellers. Okay, and again, imagine someone who is long, right? Whenever price comes into support, they say, oh, buy. Price comes support, buy. Price comes into support, buy. Where will the buyers set their stop loss? Probably just below support. And if you are long and you have a stop loss, let's say to protect you, to get you off the trade, your stop loss is in essence, right, a sell order to exit your long position. So you can imagine here a cluster of stop loss accumulate just below support. And if the price breaks below support, that cluster of sell stop orders will be triggered that will fuel further selling pressure down lower. And on top of it, right, what about breakout traders who say, oh, price is breaking out, let me short this market. So you can see that there's a strong selling pressure all coming together, right, to help push the price down lower. So this is why a descending triangle pattern is a bearish trend continuation chart pattern. So it looks something like this. Again, market over here is in a downtrend. It heads down lower, makes a pullback, heads down lower, pullback, heads down lower, makes a pullback, heads down lower, makes a pullback. Notice the pullback gets weaker and weaker. That's why you have a series of lower highs, lower highs, lower highs coming into this area of support. Okay, and then when the price finally breaks below this lows of support, you can look to go short. And this is where we say that the descending triangle chart pattern is completed and the market could possibly head down lower. Okay, so again, how can you trade the descending triangle chart pattern? Numerous ways you can trade. Earlier I shared with you the break and retest. You can look to trade the first pullback. Okay, you can even look to trade the breakout if you wish to, right? So there are many ways, many techniques that I've explained throughout this video, and all these techniques are applicable, right, to trading the descending triangle chart pattern. Okay, the bullish pennant, right? So this is a bullish trend continuation chart pattern, and here's how it looks like. So market is in an uptrend, goes up, makes a pullback, goes up, makes a pullback, goes up, makes a pullback, goes up, but couldn't break out of the highs, makes a pullback, goes up, couldn't even break above this highs, then makes a pullback, goes up. So at this point, you can see that the market, right, the volatility of the market is actually shrinking. Okay, so if you just connect the lines, right, you probably can connect the highs and the lows together. So this is kind of like a symmetrical triangle pattern, but on a much smaller scale, right? If you draw these lines at the top and at the bottom, right, you'll be able to connect the lower highs and the higher lows. So when you see this type of price action, it tells you that the market, the volatility of the market is getting smaller. It's telling you that volatility is shrinking. And as you know, right, volatility in the market, it's never constant. It moves from a period of high volatility to low volatility and vice versa. So during market periods like this is what we call high volatility market period, where there's an expansion in price, where the market is trending in one direction. This is again usually a larger volatility market environment. And when you compare to this is where the volatility of the market is smaller. And as you know, right, when volatility is low, right, you would expect an expansion in volatility. So this way, if the market does, let's say, breaks above this downward trend line over here, this is again entry trigger that you can use to get long and to ride the wave up higher. So this is what we call the bullish pennant, right? So the pennant is basically this portion over here. So on a chart, it looks something like this. Okay, there you can see it better. So notice market is in an uptrend, it makes a pullback, goes up higher, makes a pullback, goes up higher, makes a pullback, goes up higher, makes a pullback, goes up higher. So again, you can connect the lower highs and higher lows. So this is the lower high you connect over here, and then this is the higher low that you can connect over here. So notice again, the volatility of the market just getting smaller and smaller. Notice the range of the candles over here just getting tighter. Notice the range over here of the candles, right, getting smaller and smaller. So this tells you that the volatility of the market is shrinking, and we would expect volatility to pick up. And one way to get on board this bullish pennant price pattern is when the price breaks and close above this downward trend line. You can use it as an entry trigger to go along and to catch the wave up higher. So again, your stop loss again, right? So let's say over here is your entry, right? Let's say the price breaks and close above the downward trend line. This is your entry. Your stop loss, right, can just go a distance below the recent swing low. So let's say we use this as for example, this is the recent swing low. Your stop loss can go somewhere about here. Okay, so entry is here. Stop loss will be somewhere about here. Let's call it SL. Now, what about target? So usually when you trade such trend continuation chart patterns, it's useful to trail your stop loss. Maybe you can use things like a moving average, the 50-period moving average, to trail your stop loss. So if you overlay with the moving average like this, right, you can hold that position, right, until the price breaks and closes below your moving average. So that's one way to go about riding the trend up higher. Another technique that you can use there is what we call, again, the price projection method, which I talked about earlier. But for the bullish pennant, what you can do is you calculate what is the length of the earlier move. So let's say the earlier move is from here to here, from this lows to this high. So let's say, to simplify, let's say from this highs down to this lows, the distance it moves is, let's say, $20, for example. Okay, so nothing to do with the numbers on this chart. I'm just coming up with an example. So what you can do is then you take the lows over here, right, and you project up by $20 as your target level to take profit. So let's say, for example, let's say this level here is $50. Okay, so you take this $50 plus this range over here, which is $20, right? And your target profit for this particular trade, if you're buying the breakout over here, is at $70. So $70 is where you look to take profit. So basically, you're calculating the distance of this highs to this lows, from this highs down to this lows over here, and then you project it up higher, right, to determine, right, where you can take profit. Yep. Now, another variation of the bullish pennant, right, is what we call a bull flag pattern. So it's similar to the bull pennant. The story behind it is similar. Only difference is the price action, the way it unfolds is a bit different. So if you notice earlier, the bull pennant, right, you have a series of lower highs, and higher lows, right, as the price section, gets tighter and tighter. But for a bull flag pattern, you don't have this price action. What you have instead is kind of like two parallel lines, right? So this is the first parallel line, and this is the second parallel line. So in fact, you have a series of lower highs and lower lows, all right? And again, the volatility of the market, notice how it starts to shrink. So once again, right, to trade this, right, when the price breaks above the high of the flag pattern, that again could be an entry trigger for you to go long if it breaks above the high, or if you want to wait for a break and close, that is fine as well. And to set your stop loss, usually you set it a distance below the low of this flag pattern, somewhere about here. Okay, so let's say if you place a buy stop order as your entry is somewhere here, this is your entry, and let's say your stop loss will be somewhere here, right, a distance below this low. So this is how a bull flag pattern works, and this is how you can actually look to trade it. Next, we have the bearish pennant. So this again is a bearish trend continuation chart pattern. Market is in a downtrend, goes down lower, makes a pullback, goes down lower, makes a pullback, goes down lower, makes a pullback, tries to head down lower but couldn't break below the lows, then hits a pullback up higher, but again failing to break out of these highs. Then it heads down lower, again couldn't take out this low before it makes a slight pullback, which again failed to take out this highs, and then goes down lower once again. So at this point you can actually connect the highs and the lows. And notice at this point the volatility of the market is shrinking as well. So if the price can break below this this upward trend line, okay, let's say it breaks and close below it, we'll say that the bearish pennant, right, is confirmed, and the market could possibly head down lower. Okay, so to give you an example, it looks something like this. So market over here, you can see it makes a pullback, heads down lower, makes a pullback, heads down lower, makes a pullback, heads down lower, couldn't break below this low over here before it staged another rally. Try to head down lower, just couldn't break below this low before it rally. Then it heads down lower once again, and finally when it breaks below this upward trend line that you can draw, this is where we say the bear pennant is confirmed. I use confirm with a quote unquote over here because nothing is confirmed in trading, but that's just kind of a lingo that we use to say that hey, the pattern is completed. But just because it's completed doesn't mean it's guaranteed to work, because it could be a false breakout pattern. Yeah, so hopefully you understand where I'm coming from. Yeah, so again, we'll say that the pattern is confirmed, right, and the market could possibly hit down lower. So again, you might hear me saying things like might, could. I'll never say things like guaranteed, for sure, 100%. No, that doesn't work in trading, right? We are dealing with probabilities, right? Never certainty. I think that's a quote from Martin J. Pring. Yeah. So this is the bear pennant pattern, and of course its cousin, right, is what we call the bear flag pattern, which again is similar. Notice how the price over here hits down lower, makes a pullback, hits down lower, then we form this bear flag pattern. Again, see the difference is that you have a parallel line instead of the diagonal line converging for the pennant pattern, but in this case we actually have a parallel line. So when the price breaks below the low of this trend line, okay, over here, right, we say that the pattern is confirmed and the market could possibly head down lower. Okay, I know I've spoke a lot about the chart patterns and stuff like that, so let's do a quick recap to the things that you have just learned, right? First and foremost, we spoke about the bullish reversal patterns at the start. We talked about the double bottom, where the price just made a retest the bottom twice, over here, failed to break down lower, and we have this neckline. When the price breaks above this neckline, we'll say that the double bottom pattern is completed and the price could possibly head up higher. This is the head and shoulders pattern. Once again, this is the left shoulder, this is the head, this is the right shoulder, and this is the neckline. If the price breaks above the neckline, we'll say the pattern is confirmed, right, and the price could head up higher. And then this over here is the triple bottom pattern, right? Notice the price tested once, twice, 3 times, couldn't break out lower, and when it breaks above this neckline, right, we say that the market could possibly head up higher from there. And then we spoke about the bearish reversal chart patterns, right? Let me zoom in, right? So again, this is just the inverse, a double top, tested once, tested twice, couldn't go up higher. Then when the price breaks below this neckline, right, we'll say that the double top pattern is completed and it could possibly head down lower. This is the head and shoulders pattern. I do apologize, this actually should be what we call the inverse head and shoulders pattern, and this is what we call the head and shoulders pattern. This is the left shoulder, this is the head, This is the right shoulder. When the price breaks below this neckline, the market could possibly head down lower. And this over here is the triple top. Tested once, tested twice, tested 3 times. And then when it couldn't head up higher, and let's say it does break below this neckline, this market could possibly head down lower. Then moving on, we talk about the bullish, right, continuation chart patterns. We talk about things like the cup and handle pattern, right? So you can see the cup and handle, usually the pullback, the duration is slightly longer. Then we have this consolidation here, otherwise known as the handle, right? And if the price breaks out of this highs, the market could possibly continue higher. Then we have this ascending triangle pattern where we have a series of higher lows. Let's say makes another higher low into resistance. If the price breaks above resistance, right, we say that the ascending triangle pattern is completed and could possibly head up higher. Then we have the bull pennant where the price breaks above, let's say, the downward trend line, right? We'll say that again, the trend could possibly resume and head up higher. Same for the bull flag pattern as well. Then moving on, we talk about the bearish, right, continuation chart patterns, which again is just the inverse. We have the inverted cup and handle pattern. We have the descending triangle pattern. We have the bear pennant and the bear flag pattern. So again, this is just a quick recap to the different patterns that you've just learned. And I know it's a lot, right? Because we talk about continuation patterns, reversal patterns. But don't worry if all this seems overwhelming to you, because in the next section, I'll walk you through the strategy here. How do you actually use chart patterns, right, and implement it in your own trading? We'll talk about the precise entries, the exits, the risk management, the target profits, so on and so forth. So if you are kind of like in a whirlwind right now, don't worry, things will make a lot more sense, right, when we move on into the trading strategy section, right, which is coming right now. Okay, the first trading strategy that I want to share with you is what I call the double top false break. So if you recall earlier, I've talked about the double top chart pattern, and there's a technique that you can actually use to enter your trade with low risk even before the price breaks below the neckline. How do you do it? So let me explain more in this example. So you can see that the overall market, right, this is the chart of New Zealand against the US dollar, right, the daily time frame. You can see that the overall trend of this market is in the downtrend. And what's interesting is that this market has come towards an area of value. If you're not familiar with that term, it simply means areas on the chart where buying or selling pressure could come in. So this over here is an area of value. Why is that? Because it's at an area of resistance. As you know, right, resistance is an area where selling pressure could come in to push the price lower. So once I see this on the daily time frame, I want to go down to a lower time frame, like the 8-hour time frame, and look for this specific chart pattern. So on the 8-hour time frame, it looks something like this. On the 8-hour time frame, you can see that this market respecting this area of resistance. Tested once, come down lower. Tested twice, head down lower. And now we're back at this area of resistance once again. And if you look at the most recent price action, what do you see? You see that actually alright, it's still a bit too early to tell, but you can actually see that half of a double top pattern is already being formed. So this is the first half of the double top pattern. We could get another one over here, and thereby over here is the neckline, right? And then, forming this double top chart pattern over here. So what we are looking for is actually this second portion, right, to form, to show us a bearish price rejection. So let's see what happens. So in this case, the market heads down lower, 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 lower. Then it starts to rally up higher. Now over here, we are back at this highs once again. And now our double top pattern, right, is near completion, because as you know, a double top pattern is so-called only confirmed, right, if it breaks below this neckline over here. This is the neckline that we draw, right? And if the price, let's say, hits down lower and breaks and close below this neckline, we'll say that the double top chart pattern is completed. But since we have numerous factors, right, working in our favor, is it possible to actually enter the trade before the price reaches the neckline? And the answer is yes. How do you do that? Because look at this over here. You know the overall market on the daily time frame is in the downtrend. You know that this is an area of resistance that I've highlighted earlier. And you can see over here, we have actually a entry trigger that signal that, the sellers are stepping in and about to push the price lower. What's significant about this candlestick pattern is this is what we call a shooting star pattern, right? This tells us that, the price, I do a quick tutorial on candlestick pattern. The price opened over here, and at one point in time, it tried to push the price up higher. Okay, but when reaching near the highs, the seller suddenly came in and took control and pushed the price down lower, and eventually closing near the lows of the day. So this is where you have this, what we call a shooting star pattern. So the story is that the buyers, right, they got overwhelmed at this highs over here. Selling pressure came in to control and closed near the lows of the day over here. As you can see over here, near the lows of this candle. Okay, so this is an entry trigger to go short. So what you can do is go short on next candle open. So let's say you go short on next candle open. Let's highlight in green over here. Okay, let me just change this to green. Let's say that is our entry point. I'll just remove the gray box, right, since it's quite hard to see. Is there a darker green? Maybe this darker green over here. Okay. Now, what about stop loss, right? So usually I set my stop loss a distance away from price structure, a distance away from the highs, a distance away from resistance. So you know that this is resistance, right? You want to set your stop loss somewhere about here. So again, an objective way to do it, right? A quick tutorial is, again, you can use an indicator called the average true range. Search for ATR, click on this. You come out this one over here. So I like to use a 20 period ATR. I like to use SMA, simple moving average. Click OK. So what you see over here is that the ATR, the value right now is about 41, 42 pips over here. Let's make it 42 pips. So what you're going to do is to find out what is the highs of this candle over here. And then you add on 42 pips. So I'm going to get my trusty calculator and I find out what is the high over here. So the high of this candle shown on TradingView is about 0.6575, right? So the high is at 6575, 0.6575. I'm going to add 42 pips to it, so it's plus 0.0042, and that gives me a value of, let's see, 6617, 0.6617. How do I get this value 0.0042? Again, it's over here. This is a 20 period ATR. How do I get 6575? Again, that's simply the high of this candle over here. And you know, you take 6575 plus 42 pips, you get 6617. So let's see where is 6617. 6617 will probably be, let's change this to rate to signal our stop loss, 0.6617. Okay, so our stop loss is over here, this red color line over here. Great. Now what about target? So since you are now trading, right, even before the double top pattern is completed, you can actually be in profit even before the price breaks below the neckline. So here's the thing about neckline, right, as to, you know, why sometimes it's not the best time to short the markets when the price, just because the price breaks below the neckline. Because if you think about this logically, this is actually an area of support. The price could retest the neckline and then bounce up higher and continue this uptrend. That could happen. So again, if you want to be a little bit conservative, you can actually have your target at the neckline, right, where people are looking to short this market. You already take profit, right? So you can exit half your position, right, at this neckline over here. Okay, let's just change this to blue. Okay, so let's say this is your first target. Okay, and then if you, let's say you want to have a secondary target, you can do different techniques. You can, you know, let's say for example, target this extreme swing low over here as your second target. That's fine as well. So let's set this as our second target and then see what happens. So by the way, this is a cherry pick chart to better illustrate the concepts, the strategies that I'm teaching you. So it's going to be no surprise, you know, if the market, you know, reaches our target, right? So let's see. Okay, so in this case, the market quickly reaches our first target, ka-ching, profit, and then let's see what happens next. So the market then continues down lower and eventually reaches our second target over here as well. So hopefully this example illustrates to you the power of, you know, trading the double top pattern, how you can actually enter your trades even before the neckline is broken, how to set a proper stop loss, and where to set reasonable targets. Let's move on. Okay, next example, we have the break and retest on the inverse head and shoulders pattern. So you can see on this chart over here, this is the daily time frame on Euro Canadian. You can see that we have an inverse head and shoulders pattern. This is a left shoulder, head, and this is the right shoulder. And also, this will be the neckline of the inverse head and shoulders pattern. And one thing that I want to highlight is that to know whether the market is likely to reverse or not, you want to see where the reversal pattern has formed. Is it leaning against any higher time frame price structure? So for example, this is the daily time frame, okay? And if you look at the weekly time frame, you'll notice that this inverse head and shoulders pattern actually leans right against this area of support on the weekly time frame. So this is the inverse head and shoulders pattern you saw on the daily time frame, and it leans against the weekly support, right? Over here, tested once, tested twice, and we are back here for a third time. So this makes the pattern now even more significant, because this could, you know, be the long-term reversal, right? Or rather a key reversal point on the higher time frame. So now let's find out how can we get on board a trade, right, with low risk to trade this reversal chart pattern. So going back to the daily time frame, I've highlighted this inverse head and shoulders pattern. Let me just draw the neckline here. Okay, this is a neckline. Next thing that you can do, right, is that if you want to find a low risk entry, okay, you can go down to a lower time frame like the 8-hour time frame and look for an entry trigger to go long. So this is how the 8-hour time frame looks like. And my game plan over here is that since I know this is an area of value, this is where previous resistance, which could become support, I'm looking for trading opportunities around this area. All right, so let's see what happens next. So what I'm thinking of, right, is for the market to do a retest. Okay, maybe possibly a retest into this area, come back in, right? and then close back above it, right, giving me an entry trigger to go long. So let's see. So this market, next candle starts to show signs of pulling back, right? Then it pulls back pretty aggressively, and then rally up higher once again. There's no entry trigger to chase this market at this point in time. So let's see how the price reacts at this low. So right, maybe there's a hammer pattern, right, which we can use to get long, right? So as the market retests this low, so right, this is where you want to pay attention, because you know that this is a swing low. This is where buyers could step in to push the price higher. So what I'm looking for is for a rejection, for the price to close bullishly back above this lows, right, signaling that, hey, buying pressure is coming in and the market could possibly reverse higher. And if you think about this, right, if you were to have, all right, let me just continue first, okay? So over here, right, market seems to be breaking down lower, and then let's see what happens. Market then quickly reverse up higher. So this is what I call a false break. So you can see that the market over here took out this lows, making traders think that this is going to be a breakdown. The market is going to collapse lower, only to quickly reverse up and close up above this swing low, this area of support. So this to me is an entry trigger to go long. So here's what I'll do. I will then enter on the next candle open. Let's put it in green, right, as our entry price point. And then our stop loss, right, we set it a distance below this lows using the ATR method I shared with you. So I'm not going to calculate, right? If you want to know how to calculate, just watch the video a few minutes ago. Let's say our stop loss is somewhere here. Okay, let's change this to red. And for target, right, we can have our first target just before this recent swing high. Let's set it to blue as our first target. Okay, over here. Now, what's significant about this entry trigger is that, as you can see, right, when you trade this inverse head and shoulders pattern, right, you're no longer just buying the breakout of this neckline over here, and then you'll set your stop loss below the low of the right shoulder, which is, let's say, below this is the right shoulder, let's say somewhere here. You can see that the size of your stop loss from here all the way down to here is pretty darn wide, if you were to just trade the inverse head and shoulders pattern as it is. By using the power of multiple time frames, understanding basic price action, your stop loss, right, is now reduced to this size, right? Your stop loss is now from this green line to this red line over here. You can see how much tighter your stop loss is. And when you have a tighter stop loss and still remain logical, right, it offers you a favorable risk to reward on this particular trade. So let's see what happens. So in this case, right, the market, in this case, let's see, the market did eventually reach our first target, okay? And let's say your first target is met, right? Where else can you have a secondary target? So if you recall earlier, we talked about, price projection. So what you can do is actually to calculate the highs of this head and shoulders, inverse head and shoulders pattern to the lows over here. Calculate what's the distance. Okay, so let's say, I'm not going to calculate over here. Let's say the distance is X. So you just take these highs over here, you plus X, right? That will be where you can expect the market to find no selling pressure, right? So to do that, very simple, just use this indicator called the trend-based FIB extension, and so you don't have to calculate what is X. Just plot it from the lows to the highs and back to the lows once again. And over here, you'll see a few numbers. Where you want to pay attention to is the 2.0, the 2 over here at 1.3800. This pretty much tells you, right, what is the significance of this is that simply this indicator, what it does is that it calculates from this highs to this lows, right, and then project up higher. You literally just calculate this distance, right, and then copy and paste and project it up higher. So you know that the distance from this lows to this highs, let's say, is X, right? Then from this highs to this even higher highs is X as well. So it literally just copy paste. So this is where your second target could be, right, just before this 138 even level. So let's say just put it slightly below it. Let's say this is over here is your second target. So let's see what happens next. So in this case, the market did kind of like mess with your feelings. It goes up higher, breaks out, reverse down lower, almost hitting your stop loss, and then let's see if it reaches your target, and then finally reaches your target. So to be honest, right, this second target is not easy to achieve. I think many traders, before it reaches the second target, they probably would have, bailed out of the trade as the market reversed against them, right? Say, oh, Rayner, look at my open profits, it's getting smaller. Let me, book a profit, right, before I lose even more. Right? So many traders will probably do that. But if you have a plan, right, if you already have your first target kind of like in the bank, right, you already have this first target over here, you know that even if the second half of your position hit your stop loss, the most you get is a break-even trade. You probably won't lose anything more than break-even in the grand scheme of things. So let's say you hold that position all the way till it reaches your second target, then that will be awesome, right? Because you now have a pretty you have a maximize your profits on your second target, which is what you have planned originally from the start. So you can see that yes, trading can be simple, but it's not easy, especially when it comes to the psychological part of it, where you start to give back open profits. You know, you're wondering if the market is going to reach your stop loss or your target. So this will happen, right? This is the reality of trading, and so be prepared for that. Okay, the next one I have for you is what I call the trend reversal breakout trading strategy. Okay, so if you look at this chart, this is the chart of Bitcoin. You can see that this market is overall in a downtrend over here, downtrend. And then it starts to go into a range over here. And what's significant about this range is that if you go up to the higher time frame, or you just zoom out a little bit, you notice that the market is actually at this key area of support. Right, so let me just highlight to you. This is a key area of support. Okay, and this is where the range, coincides at. So notice how the price, this was resistance, price breaks out of resistance, retest becomes support, goes to the moon, and then it collapsed down lower, and now we are back at this key area of support once again. So this makes this range, right, even more significant. This range over here, even more significant, because this is what we call a accumulation stage. This is where, the sellers come in and sell, but the price just don't go any lower. Why is that? It's because the big boys, the smart money, the institutions, right, possibly, they're accumulating right at these lower prices. So this is why we call it the accumulation stage. And one thing about accumulation stage is that there's no guarantee the market will reverse up high, because for all you know, it could just continue down lower. So this is where we want to, manage our risk and make sure that, even though we are wrong, right, our losses are contained. So next, moving on, right, let's analyze this price action of this market. What chart pattern do you see over here? I'll make your life easier. I'll just highlight this this area of resistance. Okay, so whoops, what's that? Okay, just highlight this area of resistance. Okay, and you let me know what chart pattern you're seeing. Okay, so I'll give you 3 seconds. 1, 2, 3. Okay, the chart pattern over here that we are seeing is what I call the ascending triangle chart pattern. Notice the series of lower highs, or rather higher lows, higher lows, higher lows, coming into this area of resistance. Now you might be thinking, but Rayner, didn't you just say earlier that the ascending triangle chart pattern is a trend continuation pattern? Well, you're absolutely right. Earlier I said that the ascending triangle chart pattern is a trend continuation pattern. However, I didn't mention also that the ascending triangle pattern can also be a reversal chart pattern. The key difference, right, is that if you want to trade the ascending triangle chart pattern as a reversal pattern, you want to make sure that there is at least 80 candles formed in the candle. How do I know it's 80? So just take the start of this chart pattern to the end, right? Make sure there is at least 80 candles, 80, to trade this reversal chart pattern. Why 80? Because one thing about technical analysis, one thing about chart patterns is that the longer it range, the harder it breaks, right? Why is that? Because if you recall earlier, right, this area of resistance tested once, twice, 3 times, and possibly here 4th times. Then, sellers will look at this, oh man, it's time to short because the price is at resistance, so short. So when you short, right, where do you set your stop loss? Your stop loss is probably above the highs of resistance, somewhere here, here, or here. So you can imagine there's a cluster of stop loss just above resistance. And if you are short, your stop loss order is a buy order, right, to get you out of your short position, if you're wrong. So imagine, right, when the price goes up higher and hit this cluster of, buy stop orders, that will, add buying pressure to push the price up higher. And that's not all, because breakout traders, right, who see this price action and want to trade the breakout, that fuels and add even more, buying pressure into this setup. Yeah, so this is significant, and this is why I look for at least 80 candles to form before I trade this reversal chart pattern. To make your life easier, I don't expect you to go to the chart one by one candle, 2, 3, 4 candle. To make your life easier, you can use this tool over here, right? This kind of ruler tool. You pull it from the start all the way to the recent most one, and you can see over here the number of bars, right? So in this case, you can see it tells you that there is currently 129 bars. So clearly it is at least 80 candles on the chart. So the requirement is met. So now, how would you trade this particular pattern, right? So one way you can go about it is you can look to trade a breakout, right? Why is that? Because again, notice at the rightmost end of the chart, you have this nice volatility contraction, this nice build up over here. Notice the volatility of this market is getting tighter. And if you recall earlier, volatility of the market is not static. It's always moving. It moves from a period of low volatility to high volatility and back to low volatility again. So when you see a market is in a low volatility environment, it's a signal to you, it's a sign, right, that hey, something big is about to happen, right? And knowing that this market, right, you have a few factors in your favor. You are at this key area of support you saw earlier. When you zoom out earlier on the higher time frame, you have a series of higher lows coming into resistance, signaling that there's buying pressure coming in. So you want to be trading the breakout up higher. Okay, and one way to go about is that you can simply just go with a buy stop order above the recent swing high. So let's say this is the recent swing high. You place a buy stop order. I'll just remove the gray box. Let's say this green one over here is your entry trigger. So let's say the market trades above this green line, you're automatically in the long trade, right? You automatically go long on this Bitcoin. Okay, now what about stop loss, right? So again, stop loss, you can set your stop loss a distance right below the previous swing low. So this is the previous swing low. You can set your stop loss a distance below this low. Let's say somewhere about here. Okay, let's put it in red, right? So I'm not going to go through the ATR calculation because I've just covered that earlier. And what's significant about this stop loss is, again, right, you are protected by two things. Number one, if you just draw a trend line up higher, you can see that not the most perfect trend line, but the price has to break below the trend line to reach your stop loss. The price has to break below this swing low to reach your stop loss. So clearly your stop loss is at a good location. Yeah, so that's a nice thing to have. And next thing is that, when you trade such reversal chart pattern, don't go for, for me personally, I don't aim for a 1-to-1 risk reward ratio, because this could be the start of a new uptrend. Because if you zoom out a little bit, notice how much the price has collapsed from this, this highs of 20,000, come back all the way down, right, to these lows of about 3,000. What if this is the start of a new uptrend, where it reaches these highs again or breaks above that high? Do you just want to be happy with the 1-to-1 risk reward ratio? I hope not. So this way, right, what you can do is you can use a trailing stop loss. So one way to go about it is, can you use a moving average to trail your stop loss? So let's say, for example, let's see what happens. The market starts to pause, close higher, breakout, right? You probably would have gotten long on this candle over here, maybe somewhere around this green line or slightly higher if there's some slippages. Now you're long. So let's say the market continues to move in your favor, you can start to overlay with the 50-period moving average, which is shown as this blue line over here. So this means, right, if the market breaks, or rather reverse down lower and closes below this blue line, this blue color moving average, only then you exit the trade. If not, you hold that position and ride the trend up higher. Okay, so simple to understand, but not easy to do in reality. So just be aware of it. So in this case, you can see the market rally up higher, right? As the market progressively goes up higher, your moving average, your 50-period moving average progressively moves up higher as well. So this is, in a way, you're kind of like locking profits, right, as the market progressively moves in your favor. And you only exit, right, if the price closes below the moving average. So let's see what happens. So in this case, the market went up higher. Again, you're still in the trade, right, riding the move up higher. So you can imagine, right, from a risk to reward standpoint, this is like what, a 1-to-5, 1-to-6 maybe. Okay, and finally over here, this is where the market breaks and closes below this 50-period moving average. Let me just use the right tool for it. So over here, the market breaks and closes below the 50-period moving average, and that's where you exit the trade. So you can see that you have captured quite a bit of trend, right, up higher. And this is how you trade the reversal, trend reversal, right, breakout in the markets. Okay, in this example, right, look at this chart. This is the dollar against the Chinese yuan. The market is in an uptrend, and then it formed this head and shoulders pattern. There's the left shoulder, the head, and the right shoulder. And this is, of course, the neckline, otherwise known as the area of support. And right now, the price has already broke below this neckline. The head and shoulders pattern is completed. It's confirmed. But will you go short at this point in time? Think about this. 3 seconds. 1 to 3. Well, for me personally, the answer is no. Why is that? Because imagine this from a person who is short, right, his perspective. Let's say I go short over here. Where's the logical place to set your stop loss? Do I want to put it over here? Of course not, because the price could retest here where previous support now becomes resistance and then head down lower. So here is not a good place to set your stop loss. Yeah? Now, if you ask me, right, the logical place to set your stop loss, at least at a point, right, where your head and shoulders pattern is invalidated, would have to be at least, right, at 7.4 or 7.45 level over here. Because imagine this, let's say the price does rebound up higher, okay, and reach this level over here. Now at this point, you can imagine that your head and shoulders pattern, right, clearly this pattern has failed, right, because the price has exceeded, right, even beyond, right, this little head over here. So that would be a logical place to set your stop loss. But what's the problem with that stop loss level? Well, it's simple, right? Is that your stop loss is pretty darn wide, right? Such a huge stop loss. So what I would suggest you do is, again, right, you can look at this particular strategy. This technique is what we call a breakout with a build up. So once the price has broke below this neckline, right, overlay your chart with a 20-period moving average, right? In this case, it's a 20-day moving average, like this. So what we're looking for is for the 20-period moving average to catch up with the price. So now the distance between the price over here and the 20-period moving average over here is pretty wide. Okay, we want the Oh, look at the ridiculous arrow. Anyway, we want the 20 period moving average to catch up with the price, to head down lower and to touch the candle, the bar. So let's see what happens next. So at this point, you can see the market starts to consolidate a little bit and the 20 MA has caught up with the price. And the reason we are looking for this particular price pattern is simple, because as the 20 MA catch up with the price, right, we have this, what we call a build-up form over here, this nice tight consolidation. And if you recall, this actually looks something similar to a bear flag pattern, right? So you know, this is a potential bear flag pattern. And what's key over here is that, what's significant over here is that now, imagine if the price breaks below this low, right? We can go short. Let's say we go short over here, we sell. Where can we set our stop loss? Now, we don't have to set our stop loss, let's say above this highs or above this highs. We can reference this highs of this build up to set our stop loss. So imagine our stop loss is somewhere here. Now we have a much tighter stop loss. So can you see where I'm coming from? And that's not all, because if you recall, right, not sure if I mentioned this earlier, is that when the market forms a build up like this over here, you notice the volatility of this market. Volatility has shrank considerably. Right? If you look at previously, the volatility of the market is pretty high. Look at the range of all these candles over here, pretty nice and wide. Volatility is high. And market moves from a period of low volatility to high volatility and vice versa. And now we are in a low volatility environment. So now, looking at the price action, right, we know that the price has recently broke below this area of support. We have this decrease in volatility, and this means that we expect, right, an explosive move to happen in the market. So if let's say this head and shoulders pattern is the top of the market, and if let's say the market does break down lower below this lows, we can look to go short. And where can we set our stop loss? Just a distance above this high, somewhere over here. And let's say if volatility does expand in our favor, you can imagine that, you know, we'll be able to catch a pretty nice move towards the downside and also trading along the path of least resistance. So let's do just that. Let's say we have our entry trigger, just have a sell stop order just below this lows, and let's say if we do get triggered, let's see what happens. Over here, boom, right? This candle would have gotten us short in the trade. And as for stop loss, I usually set it a distance above this highs, right? 1 ATR above it. I'm not going to do the calculation. You're already a pro by now. I'll just set this, right, as blue, red color, right, as my stop loss. Now, what about targets? So for targets, right, there are numerous ways we can go about it. We can use, let's say, for example, the 20 period moving average to trail our stop loss. This means if the price breaks and closes above the 20 period moving average, then we exit the trade. If not, we hold on. Alternatively, we can use the price projection technique, right, that you've learned earlier. So what you can do is that to calculate the distance of this head and shoulders pattern from the lows to the highs, right, find out what is the distance, okay, and then you just project it, right, from the lows of the head and shoulders pattern down lower and find out what is the distance. And you can use a tool, right, like the Fibonacci extension tool, trend-based Fib extension. Just click from the highs down to the lows and then pull it up back to the highs. Okay, so where you're looking for is at this point over here, the 2.0. So at this 2 level, right, this tells you that this is where the price projection is complete. So over here can be your potential price target, right, should this head and shoulders pattern get completed. So in this case, let's see what happens. So in this case, the market did head down lower to pretty much where it is right now. So hopefully, right, this is how you can go about trading the head and shoulders pattern, right, not just blindly shorting the breakdown of support but waiting for a build up to form to get a low risk entry. Okay, just one last example before I let you go. All right, so have a look at this chart. This is the chart of Brent crude oil. Market overall is in a downtrend. Okay, and what's interesting is that notice, right now the price is coming towards this area of value, this area of resistance. I'll just highlight over here. Okay, you can see it. So over here, notice how this was previously an area of support. Price bounced up higher, pull back, bounce up higher, had a double top, right? Then price break down below this neckline, retest this area of support, had a slight bounce and now broke below this area of support. Then it hit up higher, had a slight move down lower, and right now this is the area of resistance, right? Previous support that could become resistance. Now, how can we look to trade this? So if you go down to a lower time frame like the 4-hour time frame, you can look for a specific chart pattern to help you with it. So on this time frame, the 4-hour time frame, you can see that this is the area of resistance we highlighted earlier. So what we can look for is for a potential double top pattern, right? So here it tested once, headed down lower, and it could possibly come up here again, and then to look for another price rejection down lower. If that happens, we can look to go short, stops the distance above the highs, right? And let's see what happens. So in this case, the market did try to go up higher, okay? Then it over here
we had a reversal, right? We had a false break. Notice how the price came up higher, retest this highs, then on this candle, it pretty much closed lower. So we can go short on the next candle open. Stop loss, right, will probably be somewhere about here, right? 1 ATR above the highs. Your first target will probably be just before this recent swing low, okay? So let's say I draw my entries in target, right? So let's say this is our target, our first target. I'll just change this to blue. I'll set my stop loss somewhere about here as red color, and my entry will be green, which is, let's say, the open of this candle. It's green. Okay, so let's see what happens. In this case, the market, boom, right, hit our stop loss, and yep, it's a losing trade. Yeah. Reason I put this losing trade here is because I don't want you to think, oh man, Rayner, this chart pattern stuff is the holy grail, I'm gonna get nothing but winners. No, alright? This is to bring you back to reality and let you know that, hey, trading, you will have winners, you have losers, right? Your analysis can be right? Your thought process can be correct, and there are times where the market just, pretty much, prove you wrong, and gotta, embrace it, deal with it, right? So this is why whenever we put on a trade, we only want to risk a fraction of our account, right? 1% would be ideal, right? So not lose more than 1% of your account on each trade. Okay, folks, if you have stayed with me to the end of this trading, smash the thumbs up button, because clearly, right, I hope you're loving the work that I do. And if you do, right, then what you can do next is actually go down to my website over here, tradingwithrayner.com. Okay, and over here, right, we have I want to give you a free price action trading guide. Just scroll down a little bit and pay attention to this one over here, right? So this is the ultimate guide to price action trading. We'll share with you useful price action trading techniques to help you better time your entries, exits, and even predict market turning points. So it's absolutely free. Just go down to the link, tradingwithrayner.com, click this orange button, right? Enter your email address, and I'll send this guide to your email for free. So with that said, I wish you good luck, good trading, stay safe. I'll talk to you soon.